Good afternoon and welcome to this webinar for the Baillie Gifford UK Growth Investment Trust. My name is Gavin Lumsden, I'm from Citywire in London, and I'm going to be talking to fund manager Iain McCombie about the investment trust, as well as putting your questions to him. This is a good time to get an update for Iain on the growth companies in the portfolio, given recent helpful events. It's less than 2 months since the general election ushered in a majority Labour government. Whatever you think of the result, it has helped to reassure international investors that the UK is not politically unstable. In addition, this month we've had a long-awaited interest rate cut from the Bank of England, which also starts to ease the financial pressures on companies. I suspect a stock picker like Iain might say that these big important events are somewhat peripheral to the events, to his job of picking stocks and companies. But let's hear from the man himself. Iain, good afternoon. Speaking to us from Baillie Gifford's office in Edinburgh.
Yeah. Good afternoon, Gavin. Good to speak to you.
Yeah, you too. So let's begin. It's been a difficult 3 years for your investment style. So looking at things overall, is the UK really a good growth market? Are there sufficient growth stocks here to excite investors?
Yeah. Well, I mean, the short answer, Gavin, is yes, it is. But I mean, the first thing is obviously you're right that it's been a tough 3 years, and we know that we've taxed kind of shareholders, kind of patience, and we're very conscious of that. But to your question, is there growth business in the UK? The answer is yes. Now, why do I say that? Well, look at the data. If you look at the UK market. The FTSE 100 is about 84% of the overall market. That's very concentrated. So you can imagine people like to talk about, the well-known companies in the UK, like the BPs, the Shells, the big banks, which are not really what we think are as growth companies. So that kind of colours what's going on. But if you look at our portfolio, in contrast to having 84% in the FTSE 100, we have 44%. So we're finding lots of growth opportunities outside the FTSE 100, for example. But the other way of looking at it, Gavin, is actually looking at the data. And we've got the data for the last 30 years of companies and their earnings growth over 5 years. And if you break it into quintiles, so the slow growth to the fasting growth, and you look at the different 5 quintiles, you won't be surprised, Gavin, to know that the fastest growing companies perform the best. So in a sense of, that's very similar to what we see in other markets all around the world, that the faster growing businesses do the best. Now, the point really is it's 5 years growth. So it kind of almost goes back to your point about the last 3 years being a pretty unhelpful period in the short term in terms of sentiment. But we think in the long run, the fundamentals start coming back into play. And that's why we think the UK remains a really exciting growth opportunity. And I'm sure we'll talk about more stocks as we go along.
That'd be great. And what about private companies? Because I think you're primarily thinking about listed companies there when you're talking about the FTSE 100. But the investment trust can invest up to 10%, I believe, in unquoted private companies. I don't think you're close to that level, but you can go that far. So, does the same apply to those kinds of companies that have yet to make it to the stock market?
Yeah, I mean, it's one of the great advantages of the investment trust structure is we can actually invest in unquoted if we do that. We've only got permission a few years ago. We've actually only made one investment, a company called Wave Technologies. Now, it's a very interesting business. And when we said we wanted to invest in unlisteds, we wanted to find companies that are unique, that are very, you can't find them in the listed side of things. And Wave is a great example of that. It's a very early stage business, but what it's trying to do is try to help solve the problem of autonomous driving. Now, I'm sure kind of listeners have probably heard about, there's a lot of American companies and others have raised a lot of money trying to crack this problem. But the way that they have typically tried to crack the problem is almost create rules. So that, for example, you're driving along the road, this might happen, this other thing might happen, and you create a rule and say, well, if this happens, you do this, and this happens, do that. What Wave do is very different. It's in a way, it's what it's almost using kind of, I guess, artificial intelligence to almost train itself. So almost it collects data and it teaches itself to how to get it better. And what we found in my co-manager, Milena Mileva, who's actually been driven by a car driven by Wave, she remarked, I think, even over a year, it went from being pretty impressive to very impressive in terms of the number of times, or very few number of times, that the driver actually had to intervene. So as you get more data, it gets better at it. Now, the good news that we've had as an investment in that, or to vindicate our approach, is that earlier this year, 2 or 3 very well-known big tech investors actually put £1 billion into Wave at a much higher valuation. So it's an early sign that other people are now buying into what's going on in Wave. So it's a good example of a British company that's really at a cutting edge, doing really well, and we'll see how that goes from here.
Okay, that sounds very encouraging. Which of your other growth themes look most promising at the moment?
Oh, that's like trying to pick your favourite child, Gavin. I mean, that's a tricky one. I mean, I think what I would say that is we're seeing a number of areas that are doing well. Some of our established companies getting stronger. Something like Auto Trader, that I know a lot of people will probably have been on their website. It's a number one player by a multiple, almost 10 times, I think, bigger than its number two player. So it's got a very strong market position there for second-hand cars. But what they're doing there is, and the management team, which we are very impressed by, are looking to kind of grow that market, look for new areas to get into. So what they call deal builder. So it's helping when somebody like yourself wants to buy a car. Second-hand cars, often what the problem is finance. Well, they can kind of give you links to that. You can get pre-approved. They get a small cut of that. So what we like about that is that you are growing the addressable market. So it's not just about being the number one listings player. It's getting your finger into other pies. So that's exciting. But it's also looking for new things. So, for example, a couple are relatively new holdings, a company called Kainos and Softcat. They're both technology plays, and we see multi-decade opportunities for these businesses to be, as companies, SMEs, and the public sector are using more technology. Both those businesses in slightly different ways are big beneficiaries of that, and they've got a really strong customer ethos, very strong links with their customers. And we see kind of great opportunities there. So it's a variety of things, and management teams. Some of the businesses that are very unique to the UK, something like Games Workshop. The miniature hobby game. We've got a terrific business there with IP, and also a management team that are really determined to exploit that, but keep the users on side. And that's a tricky balance, but I think they're doing really well. So in short, Gavin, lots of things that we're excited by.
Okay, I was wondering, it's very encouraging to hear that there are British companies of this ilk, because the impression you get sometimes is that this is an old-fashioned stock market that's full of oil companies and financial companies, which it is. But you're finding that those other more exciting companies. I wonder if you could say a word about a very long-standing one, but maybe one that doesn't get enough attention. But Renishaw. What is Renishaw, and how long have you held it, and what does it do?
Well, we've owned it from the trust since we took it on, but we've owned it at Baillie Gifford in our UK portfolios for probably more like 20 years. It's an engineering business, a specialist engineering business, very high-end things like probes and other very kind of whizzy kind of gadgets. They export it all over the world. It was founded by a couple of guys that came out of Rolls-Royce, and what is really interesting and unique about this business, Gavin, is the amount of money they spend on R&D. So they're cutting edge, but they spend multiples of their sales compared to most other engineering companies on R&D. Something like 15% plus, which is very high. But they do that because they think if we're going to be successful, we have to invest. We have to kind of come up with new products that the customers all over the world want. So it's in some respects, its end markets can be quite cyclical. They sell to kind of semiconductor companies and businesses which go the end demand can be hard to predict. But longer term, and that's their focus, is kind of we want to be in these areas where there's growth, and they are. So and they've done extremely well. So it's one of these classic. It's a cyclical growth business, with great IP, great management team, and a great customer base.
Okay, and in some of your other companies, like big brands, is another theme. Companies like Games Workshop, but also Diageo, Burberry. Those last two, isn't there more a sense of consumer pressure on consumer spending coming through some of those? They're not so technological and long-term growth, I'd have thought.
No, absolutely. I mean, and you're probably talking about a couple of companies that that are probably been a bit more difficult, more challenging. I'm sure people have been following the markets, but again, let's put Diageo in context. Johnny Walker, its main whiskey brand, for example, has been long. It's been more established than the United States of America. Just to put this in context, this is not a brand that's kind of here today, gone tomorrow. Some people think it's probably given more pleasure to the world than the United States of America, but maybe that's a bit too controversial. But the point is they have some very strong brands, market-leading positions. Occasionally they'll have some kind of, will they be impacted by consumer spending? And I think particularly in South America and perhaps North America a bit more recently. But the overall point, Gavin, is that longer term, it's probably not the most exciting growth business, but it is a growth business, and it keeps accumulating. It keeps compounding, and actually, it's been one of the best performing stocks in the UK market over a very long period of time. Burberry, I'll be honest, it's been a bit more challenging for us. We've been a bit disappointed by some of the management changes of late. We think it's got a core brand. We thought the management team were doing a good job of trying to, I think, get its house in order. There was a bit too much discounting before. They were trying to bring it a bit more up market. To be honest, there's been a bit of flux at the moment. We'll have to see how that plays out. But you're right, there's a bit of kind of flux there, but equally there are some strong core strengths to Burberry too. So we're just trying to think about that one at the moment.
But Ian, I've already mentioned we've had an interest rate cut from the Bank of England, and that should alleviate some of the pressure, the top-down pressure on growth stocks. What other signs, I wonder, are there that shareholders' patience in the trust is being rewarded?
I mean, I think the first thing I'd say, Gavin, is that we don't predicate ourselves. I think you said right at the start that, about interest rates and so on. So we don't think that you need interest rate cuts for, this portfolio, we think, to do well, because we think it's going to grow faster than the market, and therefore we think that will be rewarded. But, you're right also to say that, is that potentially, it has been a big headwind for the last 3 years. Like, when you said at the start, what's been tough? Well, interest rates going from 0 to 5% has been pretty challenging for growth investors. Actually, on the portfolio, the fundamentals, it hasn't been too bad, but sentiment-wise, it's been terrible. So if that's changing, that's helpful, but we're not predicated on that. But in terms of your question, which is the other one about well, give me examples of what's improving. Well, a company we've had to be very patient with is an annuity writer, Just Group, which is a kind of specialist smaller player that competes in both the bulk annuity market and the kind of individual annuity market. And what we're seeing there is very strong growth in the bulk annuity market. The irony of higher interest rates means that the funding position of all pension, corporate pension schemes has improved, and a lot of people are moving to the buyout stage. They are very strong in the particularly less than 100 million of assets. They've got about a third of the market there. That's been a very active part of the market, and they're doing extremely well. But what is interesting, and I'm sure some of the people perhaps listening into the call will know, that the individual annuity market, after being through a tough number of years, is actually booming again, partly because interest rates are higher, so actually the annuities look more attractive, but also consumer duty is forcing people to say, well, actually, should somebody looking to retire, should they have an element of their income, fixed? And they're seeing a lot of advisors who hadn't been really in touch with them for a while now wanting to get quotes again. So it's a really interesting business that's had, sentiment-wise has been against it, but they've been delivering. They had a very good set of numbers recently, and the share price has finally responded. So that's a good example where share prices do follow fundamentals.
That is a good example. Yeah, the shares shot up 16% at the half-year results last week. So, thanks for that. Your comments there about the sort of conduct rules, I think you said, makes me think of the regulator, the Financial Conduct Authority. So I was going to ask you about what seems to be increasing regulatory pressure on some of the financial companies you own. The FCA challenged wealth manager St James Place over its fees, and investment platforms have also been challenged by the FCA over the interest they pay investors on their cash. Yeah, is all of this a concern for you?
Yes, I mean, I think and certainly from speaking to the management teams, it's been one of the big issues that they have been kind of grappling with in terms of just what does it all mean. But let's kind of unpack what you just said there. Let's talk about St James's Place and that. I think initially the market was worried, are they after St James's Place? Whereas now it's very clear that it's a kind of broader perspective. But St James's Place, as the biggest player, was probably obviously the first one that they were going to look at. I think it's interesting. I mean, I think in the longer term view is, well, actually, that was the kind of concern that, for example, my co-manager, Milena, always had, is, are the fees a bit too high? Well, they've now addressed that. And I think that's, a good thing. But the market in the short term says, well, that's not good for the cash flow. In the short term, that's a bad thing. But in the long run, they're dealing with that historic kind of issue. But I think what the market was also a bit spooked by was the charge that they took earlier this year about the fact that they couldn't evidence that they had all the customers had necessarily been met, face to face. That was a bit disappointing. But let's put this in context. It's a small percentage of the portfolio and of the client base. And what's happened more recently is that at the recent results, there was no further charge made. And the new chief executive made a very upbeat kind of remark about, the growth prospects. And actually, the fundamentals of that business were actually very good. Still seeing very good inflows, despite, in some respects, all the bad publicity. So I know this may upset some of the people listening to it, but the reality is, St James's Place has got a very strong market position. It's got a lot of very enviable strengths, and they've got some very, very good people that are working for it, and you can see that in terms of numbers. So there's been a lot of controversy about it, and we are still thinking about it, but there are also grounds for optimism about it from here.
I guess it does clear out the big question that they faced, overcharges, and that's been dealt with. So yeah, they can move on. I was just going to ask you also about another of your financial holdings, very well known one, but Hargreaves Lansdown, the stockbroker online platform. Were you happy with the level of the bid it received? It looks like it's going to be taken private by a private equity consortium. Yeah, were you happy with the level of the £5.4 billion bid, I think, that they accepted?
Yeah, well, look, Gavin, you're never happy with a bid because you always want more. So, anyone who says that they're happy is never telling you the whole truth. So, would you have liked higher? Yes, we would have. I think in terms of context, though, it's important that we've actually been reducing our position there over a period of time and adding to AJ Bell, the smaller competitor of it, because we think it's been growing faster and it's been doing really well. So AJ Bell's been been a great performer for us. But ultimately, Hargreaves have got some big issues to deal with in terms of its IT transition. I think getting that customer proposition of why do they deserve to win. Now, I think that the new CEO is actually doing a very good job there, but equally it's going to be a multi-year thing to sort it out, I think. And I guess they just ultimately took the view that it's better to do that in private rather than in public. So, as you said, it looks like a done deal. So, it's a lot higher than it was from its low point, but it's still, well down from its high point. So, my feelings are pretty mixed, Gavin, as you can probably see from my tone of voice.
Absolutely. I mean, there's been quite a lot of commentary about the amount of companies that are exiting the market because of bids, because the UK stock market is cheap compared to international markets. I mean, have you been finding more of your undervalued growth stocks attracting bids like this?
I wouldn't say there's been more recently, but we've had a steady stream of them over the last, 3 or 4 years. And I would say in pretty much every case, we've been a bit sad to see them go. That, we weren't saying, oh, this is like a mercy killing, get me out of here. Or it was kind of like such an outrageous price, you take the money and run. I mean, they've been good bids, but they're not being... but we still thought the fundamentals. I'm thinking of companies like HomeServe or Euromoney or Ultra Electronics. I mean, they've all ultimately have added value to the trust. But I'd rather kind of kept on to them. Yes, I would, because our style, Gavin, is very much we like to spend time trying to understand companies and try to own them for as long as we can. So we have very low portfolio turnover. So in one sense, things like this kind of slightly upset the apple cart in the sense of that we have to find something to kind of invest in. Now, what we have done actually with that is to reinvest in the portfolio some of the kind of holdings which have been beaten up with that kind of growth headwind. So actually, it's not been too bad recently, and we found new ideas, like Moonpig, for example, which I'm sure a few people have probably used when they've forgotten they're going to send a card, they need something overnight type thing. That's a great kind of card business, but with using the platform and so on. So that there are opportunities, and so the one good thing, the long-term thing, is actually it's this kind of growth headwind has thrown up opportunities for the long-term investor, and we've been trying to kind of do that as well.
Okay. Well, on that note, you referred to just results and the positive reaction that the shares had, the investors gave those results. Was there anything else of note that you've seen in the recent reporting season? Companies doing better on the ground than their share prices might indicate.
I mean, the interesting thing, Gavin, I would have said is, people are now saying, well, look, the UK economy is maybe not doing so quite as badly as before. And to be honest, that didn't surprise us, because speaking to companies, not just, this year, it's undoubtedly tough, but it's not been quite as doom and gloom as, you read in the papers and so on. So to me, it was almost like people are looking more for a catalyst. And as you said, maybe right at the start, maybe the election and so on might be a catalyst to kind of maybe people reappraising the UK, the stock market, the companies there. But in terms of the most recent season, to answer your question, I would say it's been neutral to positive by and large. You always get one or two slight disappointments, but I think the interesting thing is companies that have had where there's a worry and where they've actually had either okay or even slightly better, you've seen a bit of a bump on the day. Just as one, but something like Inchcape, which is the car distributor, global car distributor. I think people were worried about what was happening in South America, because it's basically an international business. It wasn't great there, but it's kind of stable. But Asia there is doing extremely well. So actually the shares kind of, people are saying, well, actually maybe this is a very good business. They've also sold their UK retail assets, probably the lowest quality asset, for a very decent price. So actually now it's focused on distribution only, which is a very higher margin, higher quality business. So actually it's well positioned. So it's things like that on a micro level, bottom up level, Gavin, that we're seeing kind of grounds for optimism.
Okay. I was going to ask you about your kind of policy, really, of not investing in oil companies and the banks, some of these big blue chips that the UK is really well known for. I mean, the banks had a good reporting season. I think concerns about bad debts seem to have lessened. And, yes, are you still happy about, excluding those from the portfolio?
Yeah, I mean, the way we're trying to do it, Gavin, is we're trying to find, the 40 or so most attractive growth businesses we can find in the UK over a 5-year basis. What we still find with a lot of the banks is that, yes, they're getting a bit of a benefit from the interest rate spread and so on, but fundamentally we don't see much growth there. If you look at their loan growth or the wealth management, they're finding it difficult. We much prefer to own individual businesses like, I'd say AJ Bell. It's got a innovative, market leading position it's trying to address a real issue for consumers, and is growing much faster than the banks. And you're not having to worry about what's your net interest margin over the next 6 months and things like that, which is these things are acutely sensitive to. Whereas I'd rather invest in a business where I think I've got a management team, a customer proposition, and a kind of long-term attractive market that I think you can really benefit from. So that's why we prefer companies like that, and that's why we don't own a lot of the banks and the oil companies. It's not that we exclude them; we just think there are more attractive ideas out there.
Yeah. Okay. That's yeah. I'm convinced. That sounds very plausible. Banks don't sound that exciting from a growth point of view. What about, you're a growth investor, but dividends, the amount of income you're receiving from companies in dividends seems to have shot up from what I saw in the annual report. You had a revenue per share going up from about 4p to about 5.7p. So, and you're paying a dividend of 5.6p. Yeah, I mean, are we, is this just a reflection, high income reflecting low share price values, or is something else going on?
I mean, the first thing is we don't manage the trust with an income. We're very clear about that. We pay out, in this case, the board makes a decision on what the dividend was.
It's one dividend a year, isn't it? So it's not a big kind of income distributor.
That's right, but it's very much, it's almost like what is there at the end. We see kind of dividends almost at the end. If you want to pay us a dividend, that's fine. But frankly, if you said to me, Gavin, a company said to us, look, we'd rather cut the dividends because we think we've got great growth opportunities to do that, we're delighted. Sometimes you've had companies that said, look, we've got too much cap and too much, we're going to pay out a special dividend and things like that. Well, fine, that's great. We can use that money and we can reinvest it elsewhere. So that's fine. So we think it's a benefit for us that we're not beholden to dividends and we're not having to own companies to try and keep our dividends up. We're very clear with shareholders. The dividend will vary from 1 year to the next. It goes up and down. If you look at it over the last, since we've taken over the mandate, to us, it's more about the long-term capital growth that we want to generate for shareholders. That's the thing we think is really key. Dividends are nice, but it's not the main thing we're focused on.
So we've got a question here, sort of referencing your stablemate, Baillie Gifford stablemate, Scottish Mortgage, which essentially seeks out, the questioner says, essentially seeks out the best growth companies on a global basis, yet has chosen to have almost nothing of its portfolio in UK companies. So what is the Baillie Gifford house view on prospects of growth companies in the UK versus the rest of the world?
Well, I've got to be very careful here because, Tom Slater, co-manager, used to work with me in the UK team. So, I'm very, so Tom knows the UK market. But look, the way we think about it is Tom and Lawrence are looking at the whole, they have a broader, set to pick from. And I would be the first person to acknowledge the fact that, in terms of technology and so on, the UK does not have as many companies as, for example, there are, particularly in the US and to invest in there. But equally, if you look at what we would emphasize, that it's not just about technology. There are companies in our portfolio, something like Bunzl, that we've owned at Baillie Gifford UK portfolios for over 25 years. It's grown its earnings at 10% per annum over 25 years. You get a very exciting multiple there. So the thing I'm always saying is that perhaps the UK doesn't always have the most exciting businesses, because nobody's ever going to say Bunzl is an exciting business. But it's in the sense of, would you depend on it to kind of generate kind of good growth, that steady growth? Yes, you would. It's been through pandemics, recessions, good times, not so good times, and it just keeps doing that because it uses that cash flow to make acquisitions. I'm not saying that there aren't really faster growing businesses there, but there's more competition, there's more uncertainty. Will they be able to do that? Will they be able to do it for 25 years? If they can, brilliant. But the history doesn't tell you that. That's actually very rare to find businesses like that. So, it's horses for courses, I think. What we're trying to do, Milena and I are trying to do, is to find the best companies in the UK, which we think have got growth characteristics. Tom is trying to do that globally. So they're quite different things, but in a sense, we're trying to look at exciting growth businesses. We're just doing it in different ways for different subsets or sets of the market, if I put it like that.
Of course, yeah, understood.
Hopefully he won't shoot me for that. Hopefully he won't shoot me for saying that. So.
No, I think you're safe with that one, Iain. Digging into this a bit deeper in a way, what in your experience is the balance between groundbreaking research with potential commercial applications undertaken by UK universities versus research undertaken by UK companies?
That's a really interesting question. I mean, there are a couple of companies that have been set up in the UK to try and commercialize universities, because it's the old cliche: the UK is great at coming up with ideas and we're terrible at commercializing them. And it's often like Americans or somebody from abroad comes in and buys it. So there's a problem there. There clearly is. The universities are great at coming up with ideas. But the interesting thing is those companies have not really performed terribly well. That it's actually quite hard to do because it's quite early stage. It's probably earlier than we would like to invest in. It's not the kind of type of unquoted, for example, that we are terribly interested in. Now, we do have a company called Molten Ventures in the portfolio that does it on a pan-European basis. It's an early stage investor. It kind of has a portfolio of kind of quite interesting companies. Within that, some quite early stage ones. Other ones, well-known ones, like they have a holding in Revolut that you'll be aware of. It's been in the press. So So we're quite happy to get some exposure through that. But I think that the second point was a very interesting question. If you look at, what companies are doing, I think in a sense, it's probably, I would say, often more practical, that they're trying to build on things that they're doing, or there's a definite customer need for something. And obviously, when you're dealing with customers day to day, it's much easier to do that. Whereas if you're a university, often you can't have a great idea, then you've got to try and find somebody who's actually going to buy it. And is it credible it's somebody from XYZ university against, say, somebody from, Renishaw or something like that? It's a different thing. So they're both potentially very interesting, but clearly our portfolio is far more biased towards the company side of it, and we like companies to invest in businesses. That's, we think, one of the really key things, because again, Gavin, one of the things that's been really notable for our portfolio in the last 2 or 3 years, when it's been difficult for markets, is our companies are keep investing. Now, other companies, I suspect, haven't been, and in the short run, you won't tell the difference. But what I do know is over 5 to 10 years, you will notice the difference, because it's a classic thing, Gavin. You'll know if you don't, you could get away with not doing maintenance or innovating, but at some point that will catch up with you. Whereas the companies you want to be doing, do that all the time, so that when times get better, hopefully you can start to take market share. And it doesn't have to be high tech stuff. It can be just low tech stuff, just logistics, investing in that are still really important. Howden's Kitchens is a great example of that. They've been investing in their warehouses, investing in their logistics to improve the experience for the customer, their trade customers. Now, it'd be very easy to don't do that in the last few years, just kind of batten down the hatches. But they have rightly said, in our view, no, we keep investing there because we think that's going to increase our competitive advantage over the other players in the market. Now, you won't really see that. Well, actually, in some ways, you are seeing it already, but you won't really see it on the bottom line until you see a recovery in the markets. But in our view, you have to do it.
Yeah, keep going even when times are tough. Got another question here about renewables, really, and I'm just looking through the kind of investment themes that you've touched on, and some of the other ones: digital enterprise, digital consumer. But yeah, does the trust have exposure to green energy companies?
No.
Why not?
I mean, indirectly you will, but
Yeah.
but in terms of no, nothing direct. Trying to find businesses of scale, it's quite hard. They're more specialist businesses. There's a lot of regulation, subsidies, and so on. We're not that enthused. But look, never say never. Just at the moment, we haven't found the right one.
2 questions on the performance, and so I'll read the first one. Like we said, the past 3 years has been tough. So we've got someone here saying, I bought in 2021 and the share has been down ever since. Surely after 3 years, you should be getting back to previous levels, without blaming COVID, etc. That's one. And then there's somebody else saying, I invested £20,000 in 2021 as well. Shares are down 20%, they say. Do I sell, or for how long should I stay invested? What's your reaction to those shareholders, Iain?
At the personal level, look, I understand, and I can understand your frustration that if you've lost money, and obviously I can't give financial advice, so obviously I can't answer the question of what you do. But what I can say is that we're still doing what we did when you invested in the business, and it kind of goes back to that point about the fundamentals. We think of the portfolio have been doing much better than probably the share price has been doing, because one of the reasons why share price wise it's not been great as well is because the discount to NAV has kind of gone from pretty much zero to double digit, and that's probably accentuated the pain that the couple of the listeners are kind of pointing to. Now again, we're buying back stock at the moment because we think that's attractive use of funds, so that will be kind of in some respects additive to your things. But ultimately it comes back to we believe in the portfolio. We have not been chopping and changing the portfolio. We have confidence in it, and that's why we believe in what we're trying to do. And I'm still a shareholder. I haven't sold a share because I still believe in what we're trying to do. And I think at some point, the market will reflect the improving fundamentals in the portfolio that we've been talking about in that. So, but I appreciate, proof is in the pudding, but equally, to us, we're just keep saying, look, we're just doing what we've always done, in good times and in bad. We don't get too excited when things are going well. We don't get too gloomy when we're bad, because ultimately, we have to take risk on your behalf to outperform. And we think we're doing the right things. We've got the right portfolio, and we'll see where it goes from there. So, I'm sorry, I can't make a promise about why it's going to get better, but all I can say is the inputs are there, we think, to hopefully generate better times in the future.
Yeah, thanks, Ian. Just on that point about the discount, it might be worth just quickly sort of explaining that or broadening it out a little bit. So the shares in the trust are currently trading around 14% below their net asset value. So yeah, clearly the net asset value has been maybe unexciting then, but the share price is underperforming that. So that's why people are seeing these disappointing returns. But I guess just to pick up on your point there about
Gavin, and also probably in 21, it was probably trading at a premium, a slight premium to NAV as well. So so
you've got above NAV to below NAV. Yeah, it's what investment trusts do. Sometimes they can do the opposite, but they can do what that's just done, a kind of derating. So that's painful. But just picking up on the fact that the market not recognising the kind of the quality of the companies you're buying. Your annual results flagged up how, in terms of sales growth and profits and earnings, that your companies were, doing better than the typical average company in the UK.
Yeah, and I think that's that's the kind of the quantitative way to try and answer almost the previous question, is that if you look at what you're buying today in terms of your NAV, as you said, you're buying it at a big discount to the share price, but the fundamentals of the portfolio are doing well, and it's better quality, it's faster growing, and the balance sheets are in better shape than the market itself. Now, that doesn't automatically mean you're going to start outperforming, but what it does tell you on a medium to long term view is you are well positioned, and we think in the long run, share prices follow fundamentals. So that's the sort of thing that if we get the fundamentals of the portfolio right, at some point we think that will be recognised by the market. And as you say, discounts go up and down, but we feel we're at it's at a kind of, we think, an attractive level. That's where we're buying back stock.
Yeah, absolutely. Yeah, by buying back shares at a discount, you're actually adding to the asset value of the company at the same time. But anyway, picking up on this, last question actually for this afternoon. But the company is holding its next 5-yearly continuation vote in September, and it has said it will offer an extra one in 2027. How confident are you, Ian, that the trust can beat the FTSE All-Share over the next 3 and 5 years?
You've asked for the really tough one right at the end. Look, I don't have a crystal ball. So in one sense, I can't give a glib answer, to that. But I do think there are two things that I think are worth pointing out. I think the first one, which I've already mentioned, but I think it's really important, is that share prices follow fundamentals. That is a kind of key tenet of what we do. And as I said, the data backs that up, that the best performing companies do outperform. So what we're very much focused on is owning a portfolio of companies that have got better growth prospects, and we think have got better management teams, frankly, that will allow you to do that. The second thing, which is when we speak to companies and in our portfolio and just analyze them, the thing we are struck by is the abundance of opportunity that these companies have to keep growing in the future, not just in their existing markets, but that restlessness of, well, how can you find new markets you can build on, adjacent markets to kind of increase your opportunity set, as it were, to kind of keep growing. And I think that untapped growth potential is still not being recognised by the market in a lot of our companies. People are too much focused on the short term, the near term economic challenges. People are not trying to think about where could these businesses be in the 5 to 10 years. And we think our portfolio is in really good shape. And that's why our portfolio return has been very low over these last few years, despite the poor performance, because we still think, we believe in our portfolio. We think the fundamentals are in really great shape. So the way I would almost try and answer that question is, well, I'm very confident about the quality of our portfolio, the shape of the portfolio, and the names in the portfolio. That's what gives me confidence about the future.
Okay. Well, Iain, only time will tell, I guess, but let's hope it goes in the right way, because your conviction in what you're doing is shining through. So thanks very much for demonstrating that, and but also taking the time to be with us today. And thank you for tuning in and for sending in your questions. I hope you found that useful. Look out for more events like this from Baillie Gifford in the future.